Okay, so Chapter 7, we are talking about accounting information systems, and we're also talking about our special journal. So a lot of this I think you can probably get from the chapter, but just so kind of a basis here, or an overview. An accounting information system, it is an information system, and the point of this is to provide info to our decision makers. And those can be internal decision makers, like managers. Those can be external, potential investors or banks or any of those kinds of things. And so we need a system that will collect, record, store, and process data for us. And so we need a system that is going to, and there's not one right system, and we'll kind of see this. There's a lot of alternatives here, but the point is that we need to be able to do all of these things. It could be a paper system that could accomplish this. It could be a computer system. It's probably going to be a computer system. And there's a lot of different ways for you to organize this, and a lot of different ways for you to collect and record and store and process the data. Something that all systems should have in common, though, for the system to be effective, it needs to have it needs to provide a control process, and we're going to talk a lot more about internal controls in Chapter 8. But management will have policies in place, and so we need some way to make sure those policies are being adhered to, and that's what the accounting system can do for us. That's one of the things. It needs to be compatible with our organization structure, with our other information systems. It has to handle payroll and inventory and all these types of things. It needs to be flexible. So if we change, if we grow, if we add another store, if we add another product or process, it needs to be flexible enough that it can adapt with us. Along those same lines, it needs to be relevant. So it needs to be able to provide the information we need for decisions. And those decisions, that the information that internal managers need, for example, are very different than the information for outside users. And so for outside users and financial statements and all that, once a year is probably fine. But managers inside are going to need it much more timely. And so we need a system that can do both. And so the flexibility and the relevance kind of go together, I think, about providing the users what they need. And the main thing I want to point out with this is that it shouldn't be the accounting system says to the users, the decision makers, let's say those are managers. It's not that the system says, here's the information you can have. It's the other way around. The managers say, here's the information I need, and this accounting system needs to be able to provide it. That's how it should work. And the other thing in here is the cost-benefit relationship. So there's really elaborate systems out there that can cost a lot of money. It's not going to be the best choice for everyone. So if you're a very small business, then a simple accounting system is probably all you need. It would be the cost of a more elaborate system would exceed the benefit of a more elaborate system for you. Whereas if you're Walmart with $1 gazillion in inventory, then even though it's going to cost you millions, it's going to save you even more than that. So then for them that is worth it. So each business has to kind of decide that. And no matter what type of system you have, you will have these three basic components. So source documents. These can be invoices, or a check that you wrote, or shipping receipts, receiving orders, a bill that you got in the mail, anything like that. These are the things that initiated our journal entries, essentially. So these are our source documents that initiated that. So it needs to have the source documents, and these can be electronic or these can be paper. We need, it needs to be able to process and store this. And again, this can be a computer, or it could be a manual system of paper, but it needs to process the information and store it. And then there's outputs. So these would be reports for managers or your financial statements that you'll do. So any system that you have, whether it's super simple and you're keeping this stuff in a notebook, or whether it's an elaborate computer system, it needs to have all of these. So the source documents, the processing and the storing, and then we turn that into outputs that the decision makers can use. Okay, so let's talk about the special journals. When we, up to now, all of our journal entries have just been in the general journal. But you probably noticed that you have a lot of the same types of transactions. A lot of, I made a sale on account. A lot of, I paid this bill. I got money for accounts receivable, or I paid on my accounts payable. So, or inventory purchases. A lot of the same transactions. And so these are designed, they're kind of shortcut journals. And at first it's not going to seem like it's a shortcut, because all of a sudden this is going to seem like more work than what you did. But on an ongoing basis, this really is a shortcut. So there's 4 different types of special journals, and each one is for a specific type of transaction. So the sales journal it records any sale you made on account. And that's the only thing that goes in here. The cash receipts journal records any cash coming in. So no matter what it was for, if it's cash coming in, it goes in the cash receipts journal. The purchases journal, any purchases you made on account. It's probably going to be inventory, but it could be supplies or other things. So any purchases on account, these would all be going up to your accounts payable. Those go on the purchase journal. And then the cash payments journal is any cash going out for any reason. And then if anything does not fall into one of those categories, so everything else goes to your general journal. So that would be adjusting entries. When you sold something and people returned it, that would go under here, because that doesn't quite fall under any of those. So anything that doesn't fall under one of those 4 categories goes to the general journal. So you actually won't be using the general journal that much. And then this is out of your book. This is just a little summary. And so if you recall back to chapter 2, when we were posting to the ledgers, on the ledger it would say which page of the journal it came from. Well, this tells you now that's going to be, instead of just journal page 3, it'll be CR2, which tells you it came from the cash receipts journal, page 2. So it's that cross-referencing system becomes a lot more important, because we're actually recording stuff in 5 different journals instead of just one. So that cross-referencing system telling me where that transaction is recorded becomes even more important. The other sort of new thing we have here in this chapter are subsidiary ledgers. Okay, so far we've talked about accounts receivable and accounts payable. And when we talk about accounts receivable or accounts payable, that's the total amount that is owed to us, or the total amount that we owe. But in reality, we keep a separate ledger account for each customer. So we have accounts receivable subsidiary ledgers for each customer. And so I know not just the total that is owed to me, but specifically how much each customer owes me. And then accounts payable, I have a subsidiary ledger for each supplier or each vendor. So I keep track not just of the total I owe, but how much I owe to each person. So if I have 100 different customers that I'm selling to on account, I'll have 100 different subsidiary ledgers under accounts receivable, one for each person. And so the subsidiary ledger will show detailed information on the order or the purchase. It'll probably have invoice number. It'll have the amount that I received, if it's accounts receivable, or the amount that I paid. If it's accounts payable, the amount still owed. So it'll probably have the credit terms on there. So this is where the detail is. And so I'll have a separate subsidiary ledger for each one of my customers that I sell to on account, and for each one of my vendors that I buy from on account. And then the control account, which is the main accounts receivable or accounts payable, is actually the sum of all the subsidiary ledgers. So all of the subsidiaries roll up into the control account, which is accounts payable or accounts receivable. Subsidiary accounts. So you're going to see both of those. You're going to see all 4 journals and the subsidiaries in here. So the first problem is just getting used to which ledger to use in which situation. And so these are your 4. So again, sales journals are sales on account. Purchases are any purchases I made on account. And then any cash coming in goes to cash receipts. And any cash going out goes to the cash payments. And then all else goes to the general journal. So cash purchase of merchandise inventory. Even though this was a purchase of inventory, it's a cash one. So that's cash going out. So that's the cash payment journal. The collection of dividend revenue earned on investment. That's money that I collected. So that is cash receipts, regardless of what it's for. Prepayment of insurance. So that's when I would have paid my prepayment. So that is money going out. So that's cash payment. Borrowing money on a long-term note payable. If I borrowed money, then I got cash in. So that is cash receipts, even though it's not for a sale. Purchase of equipment on account. That is your purchases journal because you bought something on account. Cost of goods sold along with a credit sale. So this is part of a credit sale. So any sales on account goes to the sales journal, including that cost of goods sold section. Cash sale of merchandise inventory. So that's a cash sale. So that goes under cash receipts because that's cash coming in. I paid my rent. So I paid that. I wrote a check. That's cash payment. Depreciation of computer equipment. That's an adjusting entry, so that goes under the general journal. Purchase of inventory on account. So purchase on account goes into the purchase journal. Collection of accounts receivable. So that's when somebody pays you on their accounts receivable. They paid you, so you collected cash. That's cash receipts. The expiration of prepaid insurance. So that's when you used up some of that insurance. Again, that's an adjusting entry, so that goes under the general journal. Sale on account goes under the sales journal. And payment on account, I'm paying on my accounts payable, but I wrote a check, so that's cash payment. So when you get to the homework, like the first one is all about the sales journal, but it gives you a bunch of transactions. So you have to know that only the sales on account are the ones that you're going to take out of there. So here's what the sales journal looks like. Ignore the post reference for now. This is the post reference, and this is the post reference. So first, those aren't filled in. And this is a screenshot out of the book, so you can ignore the little lines for now. But this is what I do. So every time I make a sale on account, if I'm just using the general journal again, I would debit accounts receivable, and I would credit sales revenue. Let's say it's this first one, and I made a sale on account for $935. And then the second half of that, I would debit cost of goods sold and credit merchandise inventory for what it cost me, which is $505. So every time I make a sale on account, I have 4 different lines, right? 2 journal entries, 2 debits, 2 credits, and then I have to post all these over there. So what we're doing here is we're taking a shortcut, okay? So this says on November 1st. So these 2 are always going to be for the same amount, and these 2 are always going to be the same amount. This is always my debit. Sales revenue is always my credit. Cost of goods sold is always my debit. Merchandise inventory is always my credit. And since those are the same every time, I can do this shortcut. So I say, here's her invoice number. The customer, this would be the subsidiary ledger that I credited. And so you can see this is telling me what I did. I debited accounts receivable, credited sales revenue, each of those for $935. That's this part. And then I debited cost of goods sold and credited merchandise inventory for $505. That's that part. And so instead of 4 lines, I have 1 line right here. If this was a computerized system like in QuickBooks, that is all I would have to put in, and I hit enter and it would post it to those accounts and I would be done. We are pretending in this chapter like this is a manual system, just so you can kind of see what that's doing there. And so this is also just a screenshot out of your book. But you can see here are the subsidiary accounts, and so I posted each of those to their 4-column ledger. And this I do daily. Then I total up, so the total that I sent to accounts receivable and sales, and the total I sent to cost of goods sold, and merchandise inventory. This is now what I'm doing here. And so I said I credited accounts receivable for $43.19. That's right here. I'm sorry, I debited it. I credited sales revenue $43.19. That's right here. I'm saying that I debited cost of goods sold $18.14, and I credited merchandise inventory $18.14. So what I do is I probably just post these totals monthly. I need to update the subsidiary accounts more often than that, because what if I offer like a 5 days for the discount? Then I have to make sure they're within the discount. So I would update those at any given time. These ledger accounts are the same thing you did in chapter 2 with the 4-column ledger accounts. So we'll do a couple of those and I'll show you. But this is what I do. So at the time of the transaction, I've just got 1 line, and then I post it to the individual accounts. But then I don't have to do it, 25 times a day. I just do it once a month. So the post referencing, let's talk about that just a little bit. I will add this once it's posted. The check mark means it is posted to the subsidiary ledger, the individual account. And then when I fill these accounts in here, this would be with my monthly, and this is telling which account I posted that to. So we'll do one of those as well. All right, so here's one. On June 1st, I sold inventory on account to Fran Jack, $12.20. The cost of goods sold was $9.80. The invoice number was 101. So on June 1st, invoice 101. The customer name or the subsidiary account was Fran Jack. I haven't posted it yet. And so I would debit accounts receivable and credit service revenue for the 1220. And then I would debit cost of goods, credit merchandise inventory for the 980. And that's all I do for that transaction. So instead of 2 journal entries and 4 line items, I just do 1 line item like this. On the 8th, I debit, it's invoice 102. I sold it to Ireland Frank. And the sale was for $20.25. The cost of goods sold was $16.40. And again, I'm still going to send it to 4 different accounts when I post it. I'm just not going to do all that till I'm posting. But it's ultimately still going to the same place. I'm just shortcutting the journal entry. On the 13th, I have another sale on account, invoice 103. I sold this to Jake Thompson. And the sale was for $420, and the cost of goods sold was for $210. And then my last one here on 6/28 is I sold to Gabe West. Invoice number 104. The sale was for $820, and the cost of goods sold is $620. And then What it's asking me to do next here is, so this is the next one in the demo problems, to total each column. Okay, I can do that part, right? That's not too bad. And so my total here, so I probably did this on the 30th. Totals. Add up my total debits to accounts receivable, which is also the same as my total credits to sales revenue. And then my total debits to cost of goods sold is $34.50, which is also my total credit to merchandise inventory. So that's that one. The next thing, it says to open 4 column accounts with for the subsidiary accounts. And so I've got 1, 2, 3, 4 different accounts receivable customers there. And then post the transactions. I'm assuming there's 0 balances in all of these. So this is what that would look like. I think in MyLab it actually wants you to start with a 0 balance here. Accounts receivable is a debit, so it has a 0 balance on a debit side, a normal balance of a debit. So I had 0, I debited 2025, here's my new balance. Oops, kind of crossed that out. New balance. And so this is my new balance in that account. I started with 0, I debited, so this is what I did on this transaction, and then this one is my new balance, right? So I'll add or subtract to get my new balance. This is what we did in chapter 2. And so here's my new balance in each of my subsidiary ledger accounts. Once I have posted them to the subsidiary accounts, then I can go back here and tell it that I did that. So a check mark just means I posted it to subsidiary account. Then it says, okay, the next part of that, so we did that one. The next part is to open ledger accounts for accounts receivable, merchandise inventory, sales revenue, cost of goods sold. And it gives you the account number for each, and also tells me that merchandise inventory had a balance of $5,000. So I'm going to open up ledger accounts for each of these. So this would have a 0. Here's my beginning balance of $500. This one had a 0 balance, and this one had a 0 balance. So what did I do? I debited accounts receivable. If we go back to what I did in the journal, this is telling you what you did. But remember, it'll look just, it'll look just like a debit to accounts. Where did I do that one? This one right here. So it'll look like this. I debited accounts receivable and credited sales revenue for $44.85. So here's that. I debited accounts receivable and I credited sales revenue. 0 plus 4485. Here's my new balance in that account, 4485. 0 balance, credit for 4485, credit balance of 4485. And then the same thing with this. I started with 5,000 on the debit balance. I credited it, so that's a debit to a credit. So I subtract to get my new balance in this account. And then here I started with 0. I debited $34.50, so my new balance is $34.50. Once I post all of those, I can go back to my original sales journal and tell which account I posted each of these to. So I'm just putting the account number in here. So I posted this to 112 and I credited account number 411. And here I debited account 511 and credited account 118. And so now I can tell by looking at my sales journal that I've posted everything in there. Again, if you were doing this in, like say QuickBooks or something, you would just put it in the sales journal and hit enter, and it would send it to all those and update those accounts for you. The last part of this that it's asking me, is right here, the balance totals and the ending of the subsidiary accounts. What this is asking you is it says, okay, here's your subsidiary accounts. So you've got 2025 plus 1220 plus 420 plus 820. If you sum up all 4 of those, you get a total of 4485, which is what's showing in my accounts receivable account. So that's just showing that this is the sum of those 4 customers that you have. Okay, this is getting a little bit long, so I'll stop this here so it can load up, and then we'll come back and do the cash receipts journal. Okay, so let's see here. Oops.